Hey everybody, the stock market is still near record highs. That doesn't mean everything's too expensive. There are some stocks in the market that look very cheap, and we are going to talk about five of my favorites right now. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get an offer for the top 10 stocks to buy right now from the Motley Fool. It is the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. All right, so let me share my screen real quick. All right, so right now there are a lot of stocks that are still relatively cheap because of the high interest rate environment. The Fed has cut interest rates a few times in the past half a year or so, but the federal funds rate is still relatively high on a historical basis. Mortgage rates are high. The rates paid by treasuries are still pretty high. So this has caused several areas of the stock market to remain relatively cheap. Um, High dividend stocks are one big area, especially real estate investment trusts or REITs. They're very rate sensitive. The financial sector, a lot of bank stocks and things like that are still cheap. And stocks related to housing are still cheap, very cheap. I mentioned mortgage rates are very high. So it's kind of created a slow real estate market. So we're going to go through these one at a time. The first one, this probably won't be a big surprise to people who follow me, is Realty Income. Ticker symbol is O. I've called this the best overall dividend stock in the market before, and I truly believe that it's one of them. In terms of just a combination of being, having a lot of growth potential, having stability, having a high yield. It's just a really great overall company. Great track record of producing total returns that beat the stock market, despite having roughly 20% year or 20% earnings growth since early 2020. The stock is down about 35%. It peaked right before the COVID pandemic. So if we compare its pre-COVID earnings to now, they've gone up significantly, but the stock has not. Really clear-cut case about how interest rates weigh on real estate investment trusts. So this business is doing very well. The properties are performing well. Occupancy remains high. Growth is a little bit challenging because of the high rate environment, but that's really it. I'm a big fan of the stock. It's the first real estate stock I ever bought. I've been building a position for well over a decade now, and I still own. I've never sold a share. And it's one that is, like I said, at a 35% discount to its all-time high. If interest rates really start to fall, that is not going to last. Ally Financial is my number two. They just reported fourth quarter results, and the results were strong. But the big significant items are that one, it's selling its credit card business, which I'm very much a fan of that move. I like the credit card business, but Ally is just so good at auto lending that, why not just stick with that? So they're going to focus on their core businesses. Number two, we're already seeing falling rates translate to better interest margins. That should continue through 2025 and into 2026. And there's also the political tailwinds. The new Trump administration is very anti-regulation. There's no industry more regulated than banking. They want a 15% corporate tax rate. Banks generally have effective tax rates above 20%. So they will disproportionately benefit if that's the case. Very great dividend, great margins, and really good leadership. I'm a big fan of Ally. Number three is a home builder called Dreamfinders Homes, DFH. And really, the real estate market's been slow for about 3 years now, and it looked like it was going to pick up in mid 2024 when mortgage rates fell into the low sixes. But then the economic data looked better than expected. It looks like the Fed might be slower to cut rates, so mortgage rates climbed back up above 7%, where they remain right now, and it's left the real estate market very slow. Dreamfinders especially specializes in entry-level homes, which I think is going to be the biggest growth area over the next decade or so. When it comes to existing homes, we built bigger and bigger and bigger for a long time, and smaller entry-level homes are really an underserved need. That as interest rates fall, we could really see demand come back into the market for those. The stock it's down almost 50% from the highs. So it's one that I am watching very, very closely right now. Number 4 is Vici Properties. Ticker symbol is VICI, same as the name. They're best known as being a casino REIT. You see the two people there in a casino. They are the biggest landowner or the biggest property owner on the Las Vegas Strip. They own Caesar's Palace. They own the MGM Grand. They own the Venetian. They own a few others. They own a bunch of regional gaming properties. Excellent tenant quality. Most of their rent comes from either Caesar's Entertainment or MGM Resorts. Most leases are about 50 years in length. They're protected by inflation. I think 95% of their leases are linked in one way or another to the CPI. Great track record of creating shareholder value through both acquisitions and through debt investments, which they've been kind of acting as a construction lender in a few different cases. Stock is a 5.8% yield, and it's 15% below its recent high, pretty much into lockstep with interest rates. So that's one to take a closer look at right now. And number 5, this is the most speculative stock on this list. It is not for everyone. It is Redfin, ticker symbol RDFN. It's down about 50% from its 52-week high and down about 90% from its all-time high, which it reached in 2021. And really what happened between 2021 and now is mortgage rates soared, the real estate market slowed down, it became a whole lot tougher to make money as a real estate brokerage. They're making the best of a bad market. They made some smart moves, got rid of the iBuying business. They, downsized their headcount a few times, and it's not that unprofitable at this point. But it really needs existing home sales to pick up to get anywhere back to where it was. The recent changes to how buyers agents are compensated by the National Association of Realtors, it could be a big a net positive for Redfin. It's generally a negative for the industry, but a more fee-conscious consumer is a great fit for a company like Redfin, who has been the only major brokerage that has wanted to disrupt the traditional fee model in recent history. They're making great progress. They've rolled out a new compensation program nationwide to attract high-performing agents from other brokers, and they've seen great results with that so far. So I'm really curious in a few weeks to see what they did in the fourth quarter, even with a really slow real estate market, and what their plans for 2025 are. If interest rates fall down, Redfin could have a great year. So those are my 5. Let me go ahead and stop my share. I'd love to hear which ones you like, which ones you don't like, which one you think I should get rid of. I'll do my best to answer any questions or comments individually. And thanks for listening. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.